And joining me now from Dallas with more is Bill Adams. He's a chief economist at Comerica Bank. Bill, it's great to have you on the show this morning. And as we get ready for the markets to open this week, what is on your radar from an economic standpoint?
Top this week is the inflation data, and thank you again, Kristen, for having me on. The CPI report and the PPI report are coming out this week. I'm expecting the top line for both of them to be similar to what we had in January, but big changes in the details, which will tell us more about what will happen with inflation in the rest of the year.
You know, there are questions percolating, as I referenced earlier. Are we in a recession? Is a recession on the horizon amid tariffs, amid DOGE cuts to the federal government? And or is stagflation in the cards? What's your response to that?
I think the economy took a step back in January, largely due to the LA wildfires and to severe winter weather across much of the Sun Belt. But I think we'll likely have economic growth in the first quarter as a whole. As far as the outlook ahead, I do expect cuts from federal spending, cuts to federal headcount to be a headwind to growth this year. But on the private sector, I think there's a good chance that we'll see expansion of headcount overall, just at a slower pace than we saw in 2024.
So certainly traders, and I assume economists, Bill, like yourself, might want more clarity from President Donald Trump on the trade policy path forward. We heard from the Fed Chair Jerome Powell late last week. He is looking for more clarity before acting on rates. The Fed does have a meeting coming up here before the end of the month. How do tariffs, what we know of them so far, impact growth?
Well, tariffs first impact inflation. They raise prices of imported goods as importers passed on those higher costs to consumers and to their business customers in the U.S. And as businesses spend more on those imported goods and consumers spend more, there's less left over to spend on other goods and services produced in the United States. So overall, economic activity is likely to slow because of tariffs. And that's also because, from another angle, they're a tax hike. And the tariffs proposed in February and March would be a tax hike of about 0.5% to a full percentage point of GDP, which is a substantial tax hike. That's about half of all revenue the federal government brings in on corporate income taxes. Now, exactly what the tariff increase is going to be and when it's going to come into effect, it's kind of like nailing Jell-O to a wall right now. So we don't have really specifics on that incorporated in our forecast, but we are assuming the tariff rates increase this year, add to inflation, and that is a headwind to consumer disposable incomes and to consumer spending.
We do need to discuss the elephant in the room, Bill, obviously based here at the stock exchange, and amid some of these growing concerns and certainly declining consumer sentiment. At least over the past week, we've seen some selling in stocks. So worst weeks in September, I mentioned earlier for the S&P 500, that index down a little bit more than 3%, looking to open down based on futures activity 1.3% and getting closer toward that correction territory. Technically, a correction is 10% from a recent high. Do you think that those levels are warranted based on where we are in this economy?
Financial markets don't like uncertainty. Financial markets don't like policies that slow economic growth. So I think that explanation of the market reaction to date makes a lot of sense. Looking forward, though, I think the overall economic package that I expect from the administration is likely going to take the increased revenues from tariffs and the reduced government spending from the DOGE cuts and repurpose them to fund, or partially fund, a tax cut that would go into effect next year. So over a 2-year time horizon, I'm expecting the federal fiscal stance to really be more expansionary than contractionary, and that should be a tailwind to growth. But we don't see that in policy today. We don't have a lot of visibility into what tax policy would be in the next reconciliation bill, and I think that's why markets are so unsettled.
Can a declining stock market impact the economy? If sentiment worsens and people lose their wealth in the stock market, is there a correlation to economic growth?
Macroeconomists think about the stock market from two angles. One is that a declining market can hurt consumer sentiment. A declining market means that consumers have less wealth and so are more cautious about spending. and that can slow economic growth. The other dimension of a declining stock market is the stock market is itself an indicator of the outlook for the economy. And so a decline in the stock market could be a warning signal that investors are concerned that profits could fall in the future because of concerns about the overall pace of economic growth. With that said, the market tends to price in 5 out of every 3 recessions. So there's a lot of false positives thinking of the stock market as a warning about growth ahead.
Let's talk about what we heard from President Donald Trump on Fox News yesterday on Sunday, saying that the economy is in a period of transition. We've heard other members of his cabinet, like Treasury Secretary Scott Bessent, allude to the same thing, that in this change of administration, you are starting to see a shift of government policies, in this case with this administration, away from federal spending. What do you make, or can you make sense for our viewers as to what we heard from the president yesterday?
We already see the impact of DOGE cuts on jobless claims. In particular, it's most concentrated in the DC metro area, where jobless claims are at the highest, continuing claims at the highest since late 2021. So it is softening parts of the job market. It's definitely contributing to a pullback in consumer sentiment, and that's going to affect the economy near term. The outlook for economic policy, economic policy tends to change pretty frequently recently, and so I am assuming we continue to see changes with that. I don't know how long these DOGE cuts will continue, or whether they're going to intensify or become less intense. I think if we stay on this track, we're likely to see jobless claims continue to rise over the next couple of weeks. And I would expect to see the unemployment rate also tick higher in the spring and early summer months. But again, we don't know what policy is going to do. And so the economic outlook is cloudy as well.
Bill Adams, Chief Economist at Comerica Bank. Bill, thank you so much for joining.
Thanks for having me.